Welcome, everybody, to the latest edition of Trade Finance Talks. My name's Charles Osborne, Director here at Trade Finance Global. I'm delighted for this segment to be joined by Andrea Stone, CEO of Zema Global. Thank you very much for joining us.
Thank you for having me, Charles. Really delighted to be here.
Great. Perhaps a good way to start this actually might be just if you could kindly introduce yourself, maybe a little bit about your background, a little bit perhaps about Zema Global.
Sure. So as you just mentioned, I'm the CEO of Zema Global. I joined the business about 18 months ago. We've actually put 3 acquisitions together to create Zema Global. So it's really effectively a new company in the market. But, I come to this industry with 30 years of experience in data and analytics, where, I was Chief Strategy Officer of Bloomberg, CEO of Refinitiv at one point, and commodities has always been a very important asset class. And, whether it was some time that I spent with Platts or looking at, commodities through Bloomberg or Refinitiv, it's such a dynamic asset class that, when I decided to focus the next chapter of my career, I looked and saw many parallels between some of the digitalization, automation, and, electrification of markets that we saw in the last 15 years in financial services, now beginning to really enter into the energy and commodity markets. So it's very exciting to put together some innovative companies to create Zema Global to really help our industry go through digital transformation, which is desperately needed.
Yeah, absolutely. No, thank you very much for that. And I couldn't agree with you more. I think it's going through this kind of digitalization process, but it is a process, and it's always very, very interesting, I think, to see other platforms, how they work, and some of the innovations that they're doing. Perhaps you can also explain a little bit more about the type of data that Zema Global collects. Obviously, you integrate data from thousands of different sources, but how can you ensure data quality and relevance?
Sure. So let's start with the data that our customers bring us. And, I often describe the experience of working with Zema as going to your tax accountant. And you show up and you have a box of receipts, and some of them are going to be your standard forms like your P60, and others are going to be crumpled up bits, that you need to extract insight from. And this is what Zema Global does. We really take all sorts of types of data and aggregate it, cleanse it, normalize it, and help customers create their own view of a single source of truth of data that they can use to improve the quality of their decision making in their organization. So we take in pricing data, we take in market data, we take in broker data. Some brokers are kind enough to give us APIs. Some of it stuck in research reports that we have to scrape out, more so in commodities and softs. We take weather data. We take transport data, whether that's, cargo or shipping, whatever it might be. We take sensor data, right? So a lot of our customers have sensor data, whether it's a wind turbine or, drones that are going over fields, they're collecting a lot of data that's important. We take proprietary trade data from ETRMs. So all of this data, it's very varied. So there's really 3 aspects of data that we help customers manage. It's the volume, it's the variability, it's the volatility. So that data can be very volatile. It's very idiosyncratic. Sometimes data is reported, sometimes it's not. Sometimes there's gaps in the data. And then, the other aspect we have about this is just sheer velocity, right? So the velocity of data that comes off of a sensor is real-time streaming data. Meanwhile, your brokers might be reporting to you, hopefully, once a day. It could be once a week. It could be, hourly snaps. You have to integrate all of that data into a house view to get a view of how are you going to be trading either that day, the day ahead, the week ahead, the month ahead. How are you hedging and managing that risk? So that's what we do. So we take all of that data and bring it together. That's step 1. So the way we ensure data quality and integrity, first we harness all the V's, the variability, the volatility, the velocity. We harness all the V's, but we do it with science. So we have a variety of quality check processes that we bring in. We know the structure of the data. We've been working with many of these data providers for 25 years. We know the velocity of how they report that data. We know when it's late, right? Often the data can be late or absent. So we know when it's absent. We know when it's late. We know when there are restatements. We use AI to detect anomaly. We use AI to predict what the data should be, right? So we have a good sense of what's coming in, and then we have a lot of quality checks throughout our process before it ever reaches our customer to make sure that we are giving high fidelity data. The second thing is customers have their own view of the data. So I have a lot of chief risk officers that we work with that say, it's great that I put my data into a data lake, but people, they pull down, they don't understand the structure of the data, so they pull down the wrong data, and the wrong data might be used in a treasury calculation versus an end of day VAR calculation versus what's being used a forward curve for a hedge. So I love the phrase that our customers have. They want their end business users to use, but not abuse.
Right.
So Zema helps create the house curve, which is that house view that tells customers which data to use at the right time to make the right decision. And that's actually really important, because if you get the data but it's too late, that's not useful. Or if you get the data at the right time but it's absent and has holes, you can't make a decision. About 30% of our customers' P1 outages, where they can't complete a hedge, they can't complete a trade, they can't schedule a shipment, is because of missing data. So having the right data at the right time so you can make an accurate decision, we provide a lot of transparency through communicating with our customers through alerts and messages. And we have a service portal that tells customers when the data is late, missing, absent, projected, estimated, AI driven, whatever it might be. So that's kind of how we ensure high fidelity and high quality data, because it's just one thing to bring it in. I think of it almost like electricity. It has to be managed, and you want to have a meter telling you, just like you have meters to measure how fast your internet speed is, you want to have meters that tell you how high fidelity and high quality your data is at that moment when you need to make a decision. So those are really the two things that we provide to our customers.
Oh, fantastic. Thank you. Very, very informative answer on that one. And obviously, I've been in commodities a long time, and sometimes commodities can be somewhat of a closed book when it comes to data.
Yeah.
So it's important to kind of ensure many different sources. Look, just doing a deep dive into one of the V's that you mentioned, volatility. What data signals do you look out for to indicate sector volatility?
So let's talk about price. Right. So one of the things that we've seen, in particular in the last 5 years, is price volatility. We've seen swings that are far outside the norms that exist in most data models. And often those swings are due increasingly to sector coupling that we didn't anticipate 5 years ago. And it could be from a geopolitical or regulatory action, like the announcement of a tariff, right, which is an externality that we may not be anticipating. So, for years, we have a group in our business called the Data Design and Governance Group that basically sets up data models that have tolerance limits. And those tolerance limits are really there to help us understand, well, if the price is missing, how do we think about, do we go 2 days back in price? Do we average the last 5 days? How do we think about it? Those rules have to change. And when we have to scan a broader set of sectors and news and weather and all of these externalities to understand when we have a spike, where might it be coming from? Because some of the typical sources that you would anticipate, which might be, for example, a crop report or, a large transaction on the LME, those are easy to detect. It's those second and third level risks that are sort of outside the typical data sets that you would see. That's where we're able to provide more value to customers. And Zema Global has 14,000 data sets, right? We serve over 250 customers in energy and commodities. So across that breadth, we've now been collecting things as broad as social media sentiment, weather data, things like this, which again, we will quickly look at external signals to see, is this coming from a second or third or fourth standard deviation event, which is outside those tolerance limits of the things that we are used to seeing. So that, I think, and that's really some of the challenges that our customers have, is they come to us saying, I know this is the data that I need, but I don't know the data I don't know. For me to accurately look at risk, the risk manager hates is, what is it that I'm not thinking about, right? What is the data that I don't know that I need, that I'm going to need to detect something that's going to give me a price swing that's so dramatic? And that's really where, Zema can come in and add a lot of value.
No, fantastic. And of course, yeah, I mean, I think you've hit the nail on the head. There's so much price volatility at the moment. It's incredible.
Yeah.
And you know, you've alluded to one very big cause of that, which is, of course, tariffs, potential trade wars. It creates this kind of
Right.
spike, doesn't it? Just looking specifically, I guess, at different sectors and industries, perhaps starting with the global energy market. You know, what sort of trends have you observed across, across this market? And, you know, can we speak consistently about these trends? And is it reflected in the data, would you say?
So it's really looking at energy security rather than the energy transition. We started the year where we were under a paradigm of global cooperation. And we're now in a period where we're looking at more regional dynamics, where countries are looking at their national interests and they're looking at their policies, and they're starting to question the intersection of what are their natural resources and their policies and who are their trade partners in a very, very different way. So global trade flows are really starting to change. We're also seeing some bad behaviors where, ships are turning off signals. It's harder to track some crops, where the flows are going. So there's a lot more focus on data in terms of where the flows are going. We're seeing shipments suddenly redirect to go to new destinations because of changes in tariffs, and they're finding higher prices in other ports. So you may think you know where a shipment is going, but it actually changes direction quite quickly. This is causing havoc in the FX market, right? Because when you think about commodities in particular, these are historically longer dated trades, right? You're moving a good over many weeks. So you have to hedge your exposure over those weeks. And if you're seeing tariffs and if you're seeing volatility, it's going to hit your FX hedge. It's going to hit the hedge that you have against whatever commodity you have. And the price of transport is swinging wildly. So those three factors are making, commodity trading much more complicated than it was, even a year ago, because those three factors alone are very volatile. And then you have the impact of financial speculation. Right. So you're seeing more hedge funds, options love volatility, right? It's like one of the first things you learn when you're a trader. We're seeing more and more speculative trading getting into these markets as well. So, the dynamics of having speculative traders come in when you are physically exposed to a long dated trade is making this even more complex. So understanding what's going on in the derivatives market is just as important as understanding what's going on in the fundamental pricing of the market. So those things are where I see a lot of volatility when you see, trade wars and tariffs, and, it's a lot of guesswork, and it's a lot of, having to consume a lot more data than you would have historically to manage that. It's funny, I have quite a few customers in Europe that have said, I used to care about providing the lowest price to my consumer based on the energy sources, within my nation. Now I have to look at the surrounding nations, right? Like if I have an issue with an outage, right, or a transmission grid going down, I have to think about, if the global shipments get, diverted to another locale because of war or something else. The number of factors that they have to think about now is much more diverse than they were 2-3 years ago. And I think, the data can show that you have to be looking much more broadly than you probably were in the past.
Yeah, absolutely. I couldn't agree more. I think particularly over the last few years, we've probably had to deal with a lot more of this sort of tariffs, trade wars, different kind of geopolitical events, let's say, than far before. And it must be an absolute minefield at times, I think.
So, what I was talking about is, sector coupling is one of the big trends that's driving volatility. We can look at AI, for example, as a driver. We're seeing Chinese AI strategy, a national interest in the US AI strategy. Chips use highly specialized rare metals. When you see different legislation being passed, or companies even saying where their production facilities are, that's going to create pretty wide pricing swings in very thinly illiquid, opaque markets. Same thing is going to be true for renewables, right? Renewables, if you're building, wind farms, you're using steel, you're using aluminum, you're using specific parts, right, to build these, a solar array, for example. Understanding where these parts are produced and where they're sourcing their raw materials, understanding that supply chain is really, really important, because when there's a legislative change or when companies make announcements around where they're building projects, that's going to have multiple impacts on that supply chain. And you need to know where it is, both physically, how it relates to cargo, and how it relates to raw materials. And again, that degree of coupling, we know more about it thanks to Scope 1 and Scope 2 emissions focus in the last decade. But the sophistication of the supply chain is really still quite opaque. It
Yeah.
has a long way to go, I think.
But fully agree, and I think my 2 years in the renewable sector has taught me that there needs to be more alignment between the project finance space and the and commodities. Really,
Correct.
what they need from a raw material point of view, perhaps more of a vertical integration down into the supply chains. At the moment, I agree with you. I think it's very limited.
Yeah.
So there needs to be that sort of platforms that can sort of bridge that gap, I think. And no, that's very interesting. So Andrea, perhaps you can go into a bit more detail about how Zema Global's clients can specifically use the platform to navigate geopolitical fluctuations, particularly in shipping, maritime. That would be quite interesting to know.
Sure. So a little known secret about Zema is that some of the biggest energy companies in the world use Zema to price their global shipments as quickly as in 5-minute increments, right? So we are the source of truth for, Treasury, FX, commodity, and shipping prices for some of the biggest energy and gas companies in the world. So part of what we do there is we're able to provide them the data on the frequency that they need on a normalized basis, right? Because again, the data formats themselves are very different. So if they have to be currency adjusted, they have to make sure you're on the same time series. We do that today. So whether it's retail gas shipments, or whether it is looking at all your cargo and FX prices for shipping tankers, we provide that data to customers. So that's hugely helpful. And customers will tell us which sources they want, and we have a breadth of sources so we can source it pretty quickly. So that's the first thing that we can do to really help, is just to get you the data that you need. We call that decision-ready data. We want to give our customers the decision-ready data to make that foundation. The second thing that we can really do is help create the curves that you need to price things accurately, to calculate your hedges, to optimize those hedges, and make sure that you really understand the risk that you have, particularly for some of these long-dated transactions. So we have a product that's called Curve Master that really helps build the relationship you have between different price curves, right? Because it's the relationships and making sure that those curves are built correctly at the right time. A lot of our customers typically are doing things like that in Excel, where they might have it split. One desk is pricing something in one manner over here, another one might be pricing it somewhere else. We build a systematic process so that the way you're pricing curves to make some of those optimization, hedging, and scheduling decisions, that it's coordinated across the business users who are making those individual decisions. That is hugely valuable to manage some of this geopolitical risk, because again, these shocks can happen quite quickly. And if your process is such that you do things at a certain time of day in a certain part of the world, you want to make sure you're doing it off of consistent data. We also, particularly in the last year and a half, we have built up our 24/7 service capability. So, I have a background in trading. Many years ago, I was a trader, and there's nothing more frustrating than not being able to get an answer to a question when you're trying to get something done. So we have put together service that follows our customers, that does business at the pace that they do business. So if they're opening their books in Singapore in the morning and closing them, in Houston, we want to make sure that we have people available to help you understand that. And the last thing that we're doing, which is actually going live next month, is, like most companies, we have an AI agentic agent to help query what's going on in pricing. So based on the pricing you subscribe to, if you have at the moment you want to know what's going on, you can not even wait for a human. You can use our agentic AI solution, which gets all the way down into the raw data to help you understand a price fluctuation. So these are just a few of the small things that we can do to help customers react to these geopolitical changes that, again, are just causing these wide price swings that are hard to interpret. I mean, all of us get our alerts on our phone, right? The first thing you see when you have an alert, you're going to turn and you're going to look at your pricing, and you want to make sure you're looking at the right thing, and you want to make sure you know when that price is coming from. we're able to answer those questions for our customers.
Oh, fantastic. And I think it massively helps when you've got something being built by someone that has experience in the trading sector and knows exactly what the problems are, what needs to be addressed. I think it always works a lot better when you can find some gaps in that perspective. So that's no, that's very interesting to know. I'm quite keen to know a little bit more specifically about the metals, the kind of data that you're doing around the metals and minerals space. Metals is kind of my background, and I think, I'm sure you'll agree, in the commodity space, every major trader, if they're not already aggressively involved in the metal space, they're certainly doing it now. So everyone's seen a real, there's been a real upturn of that. Everyone's seen a real opportunity there. Largely, I think, because of, lofty energy transition goals that we've also alluded to earlier. Have you observed any notable supply chain disruptions in metals or mining markets recently through your data insights?
We have noticed volatility of pricing, and we've noticed when there's data gaps. There's often a lot of data gaps because things cannot be priced because of supply chain disruption. So we see that a lot. So we actually see the absence of data when there are supply chain disruptions. And that's very concerning to our customers, right? They get very concerned when the data is not coming in. We have deep partnerships, as you would expect, with the London Metals Exchange. We work very closely with Fast Markets. We work very closely with MySteel. Where there's a lot sourcing, StoneX is another one. We have all the different brokers, that are, and there's a lot of new brokers, right? There's a lot of new brokers that have come into the metals market that are starting to have views on price. We work with as many data sources as we can, and we want to give our clients as broad of a choice in terms of selecting where they want to get their price data from, because there's different ways that brokers and price reporting agencies are using different technologies to get prices on these metals. I applaud the LME for working hard to, get more electronic trading into the market. I know it's been difficult, right? Because of the nature of how metals trade, right? I mean, they're just, it's an opaque market, and there's a lot of expense that goes into extracting metals. And then of course that needs to be recouped over a rather long transport period. So, they're structured transactions. We're seeing a lot of structured transactions and forward purchase agreements, right, that have to be valued. So for example, we recently acquired a business called Sequant.io, which does asset valuations. So if you think of metals in terms of asset valuations, as opposed to a commodity that you're hedging for a trade, you look at things a little differently. And I think that is also a good perspective to have with what I would call asynchronous and synchronous portfolio valuations, right? Because an asset, whether it's a mine, right, or whether it is, the asset, for example, maybe it's a wind farm that's consuming the metal, you need to value those. And having valuation capabilities that are based on real world calculations is a need that the industry has. And Sequant has an analytical framework to help customers value their assets along with their transactions. And looking at assets and transactions next to each other, I think, is really needed in the metals market because of this supply chain effect.
Yeah. No, fully agreed. And actually, I was just going to bring up that, because what I'm quite interested in particular about is how the pricing of some of these metals and minerals is not quite aligning with what we would define as the demand based on, quite lofty energy transition goals. I mean, in particular, I was reading just a couple of days ago about, the copper pricing kind of crashing a little bit this week. So this is very, very topical. And again, it applies to tariffs, but the exclusion of refined copper. So it's, there's, again, when, this is copper, people talk about it being the lifeblood of the energy transition, yet what we see in pricing, does that really align?
So I'm a board member at a company called Expansive Limited. And I'm not sure if you're familiar with Expansive, but Expansive is the leading market infrastructure for environmental commodities. And one of the things that Expansive has is it has the largest meta registry in the world. So it is a registry of all of the renewable projects that are out there in the world. So it understands all of the terms that are underneath the financing of every single one of these projects. And it understands, obviously, the energy it's supposed to produce and then the credits that are written off of that, but also the componentry that goes into these. So it is very hard to get a good view, right, of how to price the credit, but also how to value the project. And what we find is that a lot of the financing models that were put together to value the asset or value the project were based on, a deterministic set of assumptions around the world.
Yeah.
And what's happening right now is that we need real world analytics. We need analytics that take into effect things like negative pricing, right? Like what you were just talking about in the copper market. Sometimes there's negative pricing. Sometimes there are price dips that are based on supply and demand forecasts that are based on, people's best guess. The energy and commodity markets often do analytics on data that is easily available as opposed to data that is particularly insightful, right? And I think we see that happen a lot. And that's what happens with real world data. Another thing we see all the time with, evaluation of an asset valuation in the renewable space is curtailment. Here we are in the UK, it's windy in the night up north, right? But the reality is to move that through the transmission grid down to where we are comfortably here in the south, it's losing energy as we go. So the projects themselves are being curtailed. So the payoffs and the revenue that's associated with, some of these renewable generation plants is not paying off as they were underwritten initially. So again, the only way you're going to understand things like curtailment is if you have real world data. So this is where, we're looking at the need for more models that give you what if scenario analysis that's based on real world data, real world pricing, real world volatility. We need more of that in the renewable space as it relates to both metals and as it relates to electricity, because in fact, they are connected.
Yeah, no, absolutely. And I think this curtailment problem is happening all over Europe. Spain and Italy in particular were two markets
Exactly.
I did a lot of details on, and I think that it's something the renewables market is now sort of really starting to pay attention to over the in the last couple of years. And for me, it increases the need for energy storage solutions and things like that. And these projects are particularly exciting, but again, they use a lot of metal. So there's a lot of minerals. There's a lot of raw material there. So it's all linked, and there needs to be something properly linking some of these markets, I think, and it's very interesting. You mentioned the acquisition of Sequant. That's obviously that's how I came to be introduced kindly to Zema Global. So I've known the Sequant guys for a couple of years. Really, really great team, and really, really interesting what they do in terms of valuation of renewables portfolios. So the acquisition of that, how do you think that kind of positions you guys in the market now?
So I think it creates a new category in the market, right? And I think it creates a category that we like to call decisioning infrastructure. So, when I look at, again, all of my customers in the energy and commodity space, I see a pattern that reminds me of financial services 15, 20 years ago, where every asset class, whether you're doing gas or whether you're doing, ferrous metals, or whether you're looking at ags or whether you're looking at power, they all have a distinct trading stack, right? And ETRMs are optimized per asset class. Mm-hmm. And the challenge that we have now, what we've been talking about, is there's interoperability and volatility impacts between asset classes, right? And we saw this back in 2008 in financial services and fixed income in particular. We have to be able to make decisions. So what we see is these 1990s siloed asset classes where you have technology that was really designed to operate for the day ahead, right? It's not operating intraday. So there's a series of workflow activities that need to be elevated into what we call decisioning infrastructure, where you can make decisions, where you can understand the interoperability and the interactions of different asset classes against each other, right? So decisioning infrastructure is really taking your data infrastructure and your analytics infrastructure and connecting them so that they can work dynamically in real time. You start with a decision-ready data foundation that goes across these different asset classes and factors in things that get you at that second and standard third deviation of volatility, looking at weather, looking at transport, looking at sensor data. You really want to take all of that data and have it be ideally AI, but decision ready. Use that to create derived data that's consistent, connect that to your valuations and your trades, and ultimately flow that through to your portfolio analytics so you can look at the total portfolio and run what if queries, right? I mean, it sounds simple, but how do I evaluate a certain scenario so that I can make a decision that day or get myself prepared for the next day between one asset class that might be affecting another? That is really hard to do right now in our industry. So we like to think of this decisioning infrastructure as the series of tools and data that will help the industry answer those questions in a much more dynamic fashion.
That's fantastic. No, very interesting to know, and I can't wait to sort of see how this develops. That sort of alignment there. Just a last question from me is, looking forwards now, how do you anticipate data collection in these industries evolving, in both in terms of Zema processes and in market trends?
So I see really two key trends. One, customers are getting savvier with their own data, right? 5 years ago, I ran a customer conference with a provider that has 60% of the ETRMs in the industry. And we got all the customers together. And one of the things that they said was, we're storing everything. We're storing all the data that we have. I love calling the energy industry, the pack rats of data, because so much data is stored. I've had customers come up to me and be like, I've got all this, sensor data in a BigQuery database, and I don't know what to do with it. That's going to change. Right. And, we're getting a lot more sophistication in understanding how customers can unlock their proprietary data that they're getting from their physical operations, their physical infrastructure. They're going to start gaining a lot more insight from that to really help them operate more efficiently. So I see customer generated data as a real trend in the future.
Okay.
The second, that's definitely happening. And I'm super happy and excited to be a part of that. The second thing that I see happening is I'm seeing more data providers coming online that are using AI and intersecting these data sets to be more predictive. And whether that is, crop yields in Brazil, or whether that's, looking at shipping data of LNG cargoes, or it could be brokers that are using quantitative methods to calculate price in a predictive way, using a slightly different methodology. I'm seeing a lot of new entrants. And I think that's really exciting because, they're applying technology to deep industry knowledge to help us think about what is going to happen as opposed to what has already happened. So I think you have to couple those data sets together, right? You want to couple the customer proprietary data with the predictive and AI generated data with the historical data. Historical data is going to become more valuable as well. We have customers that we work with that have 25, 30 years of data. That data, what we saw in financial services, we will see in energy. We're going to use that to train our algorithms, right? We've been working with some of the leading banks in the world to reconstruct their historical commodity pricing data. And it's because they're using that. More algorithms are going to be applied towards taking any sort of action in this industry. It could be towards how you operationalize and switch turbines on and off in the grid. That's going to be based on what we call this decision-ready data that is going to be both predictive, historical, real-time, and as traded. All of those have been historically segregated. And I think we're going to start seeing those interacting in real time and in a much more dynamic basis. That's coming.
Fantastic. Well, there you have it. Customers have become more savvy, and we need to be a bit more, a bit smarter and a bit more predictive with some of these data sets. No, incredibly interesting, and I think I agree. Looking at historical data and doing a deep dive into that as well. Just speaking from my knowledge of the commodities market, it's very cyclical. It's very cyclical. So, it's worth looking back to go forward, I think, at times. So, no, just the last point I can make is just to thank you, Andrea, for joining us for this latest segment of Trade Finance Talks. Thank you for your time.
Charles, thank you for having me. Really happy to be a part of the Trade Finance Network and would love to spend more time with you live and in person.
Fantastic. This won't be the first time you hear about Zema Global and Sequant, that's for sure. Thank you very much.
Thanks, Charles. Take care.